Call the meeting to order.
I think so.
All right.
Do you have your agenda?
I don't, but I think the first order of business is the roll call.
Yes, it is. Landon Moore,
Landon.
I'm present.
David
Okay.
Holly,
Here.
Mark Munson, Mark Gardner,
Here.
Taryn Savage. Here. Stephanie Elliott William, Danny Covey,
Here.
Joel Hawkins, so we have Mark and Stephanie out, but that still is a quorum. Mr. Challenger,
Here.
Phillips, Mimi's not here. Right?
Yes.
And Mimi's, you all know Flora Barcia?
Barisha.
Barisha. She
First time.
is the Director of Finance
Oh, good.
for the city, and so she helps prepare a lot of the reports you used to see, and of course does all the accounting for it as well.
Nice to meet you.
Except for
Nice
the
to
stuff
meet you.
that
Welcome.
John Hancock and Greystone on this end. So we have a quorum, so I turn it back over to you, Mr. Moore.
Next item is the minutes. Does anyone have comments, questions on the minutes?
I have a couple questions, if I may. Under old business, there was a line item, follow-up will occur to determine if there was an annual meeting held in 2021, and if an annual report was available. Did we have an annual meeting in 2021?
In January 2021, a briefing was held to City Council, but in terms of an annual meeting of this group, no.
Okay, all right.
The EML vaco, is that what it's called? They had their annual meeting, and we did receive a report from that, and a performance report, which I think Patty was going to touch on in the
Okay.
next item.
All right. And there was some mention, potential of 15 to 20% correction. Are you going to touch on that today? Okay.
Absolutely.
Did that happen?
We're in the halfway there.
Numerous times, yeah.
I haven't
Depends
been
on
watching
time
the
of day
news.
you ask.
Okay, that's all I've got. If Brian's going to address that, that's all I've got, so.
Do we have a motion to approve the minutes?
So moved?
Second.
All in favor?
Aye.
Minutes approved. All right, Patty, if you could touch on the OPEB trust.
I will. Well, a couple things. I believe that we've got a January 31st report that says that the Portsmouth has $6,731,192.71. And you compare that against December 31st, we are down $265,297 just due to market changes. And of course, I don't have the February numbers were not available. So there's also in your package a copy of the VML VACO annual report. It looks like this, the full trust. And there's a great description in the management and discussion and analysis, usually around between page 4 and 6. It goes into details as to the holdings, that there is a 1.7 billion in this pooled trust right now. It's a huge fund. And we break it into, you can be in Portfolio 1 or Portfolio 2. Portfolio 1 is a little more weighted on equities. Portfolio 2 is a little more weighted on fixed income. so you can just decide on what risk you're willing to deal with and how much volatility you're willing to swallow. But again, I invite you to read this. They are professionally managed, actively managed, and the fund fees are very low because we have such a large volume. And just as an aside, which is not for the official record, of course, but I'm more familiar with this group in that I represented Virginia Beach City and Virginia Beach Schools on it when I was finance director. And I looked at other options to place this OPEB money, and this was by far the least expensive option for a city, for a municipal government. Am I making any sense? I also looked at what our liability is for retiree health care, and the liability is $19.3 million. And of course, we have this $6.7 million asset, so we're roughly 35% funded on that side. And that's a decision that City Council decides on how much they're going to put in. Thank you.
And it's
Take one down.
been 3 years since you put the money in, something like that?
Yeah, it's not, maybe 4, but not a whole long time. So it hadn't had a chance to build up. Virginia Beach put theirs in earlier on, but it's still 35% considering how new this whole requirement is not that bad.
Did it used to be that cities did not fund these things?
Well,
all?
you might remember the Governmental
Thank you.
Accounting Standards Board did not require local governments to report on their financial statements the liability for pensions and other post-employment. So what's happening is slowly we're being required to do that. In fact, lease accounting will be starting this year. So that's a new one as well, whereas the private sector's been doing it since day one.
So once the requirement was to report on the liability, then that sort of set the wheels in motion for municipalities to start funding them?
Everybody started paying attention.
They're still woefully underfunded.
Yeah.
You know, everybody talks about the dire straits that the public pension system is in, and that's true. But then you start looking at retiree health care, and most states and municipalities are pay-as-you-go.
I thought it was pretty good that you went from 0 to 35, 40% in a few years.
Yeah.
Is Portsmouth making an annual contribution to this?
Yes. Yes, it's a budgetary issue, you know, that it's very easy, as you all know, to provide for benefits for somebody who's going to retire sometime in the future, and without recognizing that liability, and people are paying a lot more attention to it. And in fact, Portsmouth, and just this is more detail than you really want, but Portsmouth, I'm trying to think, this is before my time, maybe 5, 6, 7 years ago, changed its whole health care for retirees drastically and brought that number down and cut it more than in half. So that is a great step in the right direction for Portsmouth. But you know, people come to work expecting this benefit. They are promised this benefit, and so you're not going to do away with it altogether. I had always said we ought to, for new retirees, change it, but I think that human resource management may look at the fairness of all that. So it's just, that's the life in the public sector. That's all I can say. And I'm passing out now the memorandum that they're having a live meeting, the OPEB board, on March 18th. And this is their report, their quarterly report that they're giving. So I'm passing that out, and I'm also passing out the account of the from Co-America. Co-America holds the OPEB money in trust on behalf of the city, of course. With each locality has its own account. So it's not commingled, it's invested together, but is held in trust by each one. Okay. I think I'm supposed to pass out this.
So I'll just point out on page 2, you can see for portfolio 1, the last bullet, the 5-year annualized return is 11.57 versus the benchmark of 10.75. Exceeding the benchmark over a 5-year period by 75 basis points is, I would say, is good. So, I mean, I don't think there's any concerns with the management of that so far.
And there is a whole lot of information available, goes into the excruciating detail of every investment against its benchmark. I did not include that in your package, but if anybody wants it, I'm happy to provide it.
Does anyone have any further questions, comments on the OPEB trust? Okay. Next, if Ms. E. Wright would like to review the retirements.
Yes, I handed you out the applications for retirement and death report. There, since August of 2021, for the PRS, there's been 3 deaths reported, and for fire and police, there's been 7. You see where August, September, and October are listed here. They were not on the previous report because they were not reported to us at the last meeting. For active participants for fire and police, there are 6, and for the Portsmouth Retirement System, there are 11. Okay, concludes the report.
Okay.
All right. There's no questions about that. The next item is Greystone's review of the investment portfolio.
Great. Well, thanks, Landon. Good morning, everyone. It's nice to be with you in person, particularly given some of the things we're going to talk about today. I'm going to review calendar year 2021 results, returns in the major capital markets, because I think it provides a little bit of context for what's going on the early part of this year. But clearly, the world is different today than it was even three weeks ago, I guess, or even 2 weeks ago. And so, obviously, the whole situation in Ukraine is very fluid, and we'll certainly talk about that and the potential implications of it. But I do think it's relevant and important to just kind of refresh all of our memory about 2021. I'm going to start on this slide here, which is page 3, and then I'm going to just touch on this. I'm going to turn it over to Jim. He's going to talk about our outlook. And then I'm going to pick the portfolio back up, talk about 2021 results, and then there is a separate handout that shows results through February of 2022. So again, on page 3, if we were just to remember what 2021 looked like, the U.S. equity market is measured by the S&P 500 index, so an index of large capitalization stocks in the U.S. was up almost 29%. Now that seems like forever ago, and for sure it was, but a 29% return is the 3rd consecutive year of double-digit positive returns for the U.S. equity market. Now, if you look under the hood a little bit, and not at the headline number, but look through to the individual stocks that comprise that index, what you'd find is 5 companies accounted for 35% of the return. Apple, Tesla, computer chip company, NVIDIA, Microsoft, and Alphabet. Those 5 companies, which are some of the largest in the index, accounted for 35%. So once you strip that out, the other 495 stocks returned somewhere in the mid-teens. Still good, don't get me wrong, but not as eye-popping as the headline numbers would indicate. What's not on this page is the small cap universe. So the Russell 2000 index, the 2,000 smallest companies in the US, was up 15%, roughly 15%. And if you go through that same exercise and look through, there were 2 companies in that index that accounted for 11 percentage points of that return. The so-called meme stocks of Gamestop and AMC movie theaters. And you might recall in the late winter, early spring of last year, on a message board called Reddit, the retail investor became aware that there were some big hedge funds that were short those stocks, concerned about their business models, long-term viability of those companies. So word got out that these hedge funds shorted the stock. The message board said, hey, wouldn't it be great if we all went out and bought a few shares of this thing and brought the hedge funds to their knees? And they absolutely, positively did that. GameStop's return in 2021 was something like 700%. AMC movie theaters was up 1,200%. The 2 of those combined for 1% of the index, but because they were up so much, they accounted for 11 percentage points of the return. Now you strip that out, what's left? About 4% returns for the other 1,998 companies in that index. So the headline numbers were strong, and I'm not diminishing that to any extent. But when you start looking at the typical company or the average company in the US equity market, the returns are not, in 2021 at least, weren't as great as the headline numbers would indicate. Non-US equities were up about 8.3%. Now this is a combination of both developed markets outside the US, so continental Europe, UK, Japan, Australia, but it also includes emerging markets. So if you were to bifurcate those 2, developed markets outside the US last year were up about a little bit more than 11%. So certainly less than the returns that we experienced in the US equity market. But if you make that adjustment and pull out those 5 stocks in the S&P 500, the returns are more similar. And what was going on in 2021 is part of what was going on in 2021 is the dollar was strong. And the dollar had its best return, I think, since 2013. Dollar rallied something like 6 or 7%. That tends to be bad for non-US stocks. So you make all these adjustments, you factor in the currency, you factor into the account that 5 stocks accounted for 35% of the return. Non-US stocks and US stocks look reasonably similar during 2021. We haven't seen that in a long time. Look at, on the emerging market side, emerging markets were down a little bit over 2%, between 2 and 2.5%. And so, again, just summarizing, global equity markets, or stocks around the globe, pretty good returns, really good headline returns here in the US. Underneath the surface, maybe a little bit less compelling. And then, outside the US, still pretty strong returns. And I think it's important to point that out because when we talk about results here in 2022, yes, markets are down. Markets are down about 10% around the globe. But 10% off of something that was up 30% last year, I think we need to, remind ourselves that what we're experiencing and how we got to where we are today in this year is a little bit unique and unusual. But this stuff happens all the time. 10% corrections happen in any calendar year, typically, and this is true when markets are up for the calendar year 2030 and even 40%. There is some point in that year, typically, where markets reach a peak, decline at least 10% before they start resuming their upward trend. Now, we have a little bit different perspective about what's going on now, and I know Jim's going to talk about that, but again, I think it's important we put today into context of the results that we had in 2021. Last thing I'll say on this side is on the fixed income side. So bond markets, interest rates have gone up, right? And that's bad for bond prices. When interest rates go up, bond prices go down. The broad investment grade US bond market was down about 1.5% last year. continues to be down today. And interest rates are going up for, well, a few reasons. Number one, the underlying strength of the U.S. economy is still pretty strong. It's slowing, but economic growth is still positive. That tends to result in higher interest rates. We're all feeling the effects of inflation, particularly at the gas pump, and pretty much the cost of everything else. Whenever you have higher levels of inflation, interest rates tend to go up. And there is this expectation later this month that the Federal Reserve is going to start normalizing monetary policy. What does that mean? They're going to start increasing short-term interest rates. So in light of that, across all bond maturities, interest rates rose in 2021, and they continue to do so in the early part of 2022. We'll talk about our view on rates, but that drove bond prices negative, and that's the reason why you see the negative returns there. So with that, I'm going to stop. Jim's going to talk about outlook. I'm going to come back and talk about the portfolio, but that was just to refresh everybody's memory about what was going on last year.
Thanks, Brian. Good morning, everybody. It's great to be with you. I recognize your face from Zoom, but it's wonderful to be live with you all here in Portsmouth. I have a number of things I want to talk about this morning. In our primary book, the first slide I'll look at when I get to the slides will be slide slide 4, right after Brian's market performance outlook. Also, I provided you with 2 handouts. The challenge with charts and handouts is that the market's moving very quickly. The world is very dynamic. We have a war, unfortunately, in the Ukraine, tragic loss of life, which we all think is avoidable, is on the top of everybody's mind. And so we don't have time to go through all of this, but I did want to provide you with this report. I think it's probably one of the most comprehensive, if not exhaustive, reports that's available in the market today about the implications of Russia invading the Ukraine and essentially the globe shutting down business with Russia, and what are those implications. We're just learning about those implications, but I think this report, which was written by, we have strategists from around the world participating. You can tell by their phone numbers. We have our New York strategists involved in this report. We've got a team from Asia. We've got our London team, all putting this together, answering what we think are some really important questions about the implications of Russia's what will be their collapsing economy. So there's a lot of great information here. We talk about Russia and the Fed's path towards tightening, which I'll cover in a minute, but effectively it's unchanged as a result of that. If you look at this slide, Russia's commodities on slide page 5 in the handout. So this graph here shows Russia's production of certain commodities, certainly very, very important for a lot of different businesses. You can see the palladium, platinum, nickel, zinc, cobalt. A lot of this is what you would find in electronic vehicles, in the batteries as an example. And so it's interesting to see that stocks like Ford, GM, Toyota, Honda, which have future production tightly geared towards electronic vehicles, EV vehicles, those stocks have had started to roll over and underperform pretty badly in the last 10 days. And part of that can be attributed to a shortage of what they're going to need to produce those vehicles, because so much of that came out of Russia. So that's the level of detail I think you'll find in this report. I'm happy to answer additional questions, but I'd rather get into sort of some of the macro issues that we're facing today and how it affects our thoughts around the portfolio. So before I jump into any of these slides, I thought I would just give you a brief overview of the landscape as we think about the economy, interest rates, and the stock market, just given current events. We can't keep the slides up to date fast enough, so I'm going to share with you our views. I think it's really important to refresh where we started the year. And we started the year with Chairman Powell walking back his narrative that inflation is transitory, that you won't hear that term coming out of the Fed anymore. So inflation is going to be a persistent problem. It's completely scrapping that view. And yet we still have a Fed that is keeping interest rates at its pandemic policy target of near zero. And I'll give you a brief update about where we are in the economy. So just hold that thought. Interest rates near zero to help stimulate an economy that you'll hear in a few minutes is perhaps, in our view, overstimulated. So what's different this time between last tightening cycles? So certainly the Fed had made a move a while ago relative to the economic data we have and the pathway that they're taking now. So it's well known that they're behind the curve. Inflation wasn't transitory. So we have low interest rates. We still have the Federal Reserve buying $40 billion a month of mortgage-backed and Treasury securities. That program will end at the end of March, but it was designed to help prop up the housing market, keeping the 10-year Treasury and the Treasury curve in general low. And effectively, what the Fed was doing was they were stabilizing the volatility of the bond market on the Fed's balance sheet, which is a strategy that the Fed has used in the past to help the housing market. So what has happened as a result of that? Well, we've probably had one of the highest increase, 20% year over year last year, increases in housing prices that we've seen in probably 35 to 40 years. And there's a number of measures that we look at. So one could argue 20% pop in housing prices. If you are all looking at any of these major metropolitan areas, you know that a house comes on the market, it's sold that day, and it's probably sold over the list price. And this was what creates the boom-bust cycle in the housing market. So just another indication the Fed's probably behind the curve, raising rates, causing a lot of unnecessary stimulation at this point in the cycle in the housing market. We had GDP growing at 7%, and that's the fastest growth we've seen since 1984. So a really strong economy, and I'll talk more about our views on the economy this year. Consumer Price Index. Consumers experienced about a 7% price increase last year. At the Producer Price Index, sort of the wholesale level, before it gets to the consumer, that's running at about a 9% rate. And we know with the war in the Ukraine that higher oil prices, the commodity prices that I just showed you, those are all up 30, 40, 50% in some cases. Hasn't begun to work its way through to these inflation numbers. So we'll just call it double-digit inflation that the Fed has to work on. Unemployment. We ended the year at 3.9%. The February number came in at 3.8%. So this is about as low as we saw, which was 3.7% in 2018, which was a 50-year low, which most economists thought we would probably never get to again. So by any definition, economists would say that we're at full employment. So you look at interest rates, Fed buying bonds, inflation, unemployment, and the Fed hasn't made a single move yet. So the reaction and anticipation has been violent, but the Fed itself hasn't made a move yet. So in terms of rates, our forecast is for 6 25 basis point increases in this calendar year, and then another 100 next year. So that's a lot of information for the market to digest. And of course, when you have that level of catch-up that the Fed has to undertake, investors are concerned about a policy mistake, meaning maybe the Fed was too slow to tighten, and they're going to be too aggressive to try and squelch out the inflation that's in our system. History tells us that's the risk, and that it's not so much that the Fed, investors all know what I'm telling you, but the concern is that it's going to be too much too late, and that is what will tip the economy into recession. I think the good news is that the U.S. economy, in our view, is still quite strong. We expect 4% GDP growth, so it should be able to absorb a lot this year. Now, things can change. We're living in a pretty volatile world, but at the moment, 4% seems quite solid to us. If we look at the February jobs creation number, 675,000 net new jobs, incredibly strong number of new jobs created. And we still have 11 million unfilled jobs in the country. So the backdrop of all this really is quite healthy in our view, and we're fortunate that the economy is doing well and we'll be able to absorb a lot of these shocks. One of the questions that we often get is, well, what is your view about a potential recession? And just in the last probably 10 days, this is just prior to the war, the narrative has been with the Fed's very tight tightening campaign, what's the risk of recession and how do you look at that? Well, one of the things that we look at and others look at is the spread between the 2-year U.S. Treasury and the 10-year U.S. Treasury. And when that starts to narrow or invert, meaning the 2-year Treasury yields are higher than the 10-year, history tells us, going back to the 1960s, that's been a pretty good harbinger of a recession 12 to 18 months out. And so we started the year with that 210 spread, if you will, at about 1.06%. And today it's about 25 basis points, down to 0.25%. So something kind of for us to all focus on during this tumultuous time, and I think it will impact perhaps our views on our targets for equities in the U.S. So something to keep in mind. One thing else, I'll talk about the war in Russia. Russia accounts for about 3% of U.S. oil. So it wasn't a terribly difficult decision for the Biden administration to say that we don't want to be part of President Putin's campaign and fund his war. That's very different for Europe, where it's almost 30%. So much more challenging situation there. To put the size of Russia in perspective, their economy is roughly 1.4 trillion in size. Ukraine is about 155 billion. So in a global context, it's meaningful, but it's not overly significant. So there will be a contagion effect, but just given the relative size of Russia and certainly the relative size of the Ukraine, it shouldn't be catastrophic for Europe or for the United States, just given its relative small size as a player in the ecosystem. No two financial moments in history are similar by any stretch. We know that, but there are lessons learned. And so we went back and looked at the 1998 Russian default, and they defaulted on both short-term and long-term debt, and it was about $45 billion of default. And at that particular point in time, within 2 weeks, the S&P was down almost 12%. So S&P today, with this Russian-Ukraine war, Fed tightening, down about 12%. Again, different backdrop, different scenario, but it was, at the time, a $45 billion default was considered very significant. And the S&P went on to recover in about 7 months' time. So just a little bit of history, a little bit of perspective that maybe helps share a framework for how to think about this Russia-Ukraine situation. So I'm going to move back into the meeting book and talk about some slides that we think are worth tracking, and hopefully we'll review these next time.
Do you remember, you had shown a slide before about that 10-year Treasury, 2-year Treasury spread, and you had, like, from the time it inverts to X number of months until the economy goes into recession, and then also the market reacts to it. That happened not too long ago. Was that before the pandemic? I can't remember if it happened before the I guess it would
Where
have
the
to
curve
be.
inverted.
Uh-huh. It was like briefly, I thought it was like in January.
Oh, there was a very short period. It was like, it inverted.
It was, and I think it was prior to the pandemic.
It was prior to the pandemic, but it didn't last very long at all, like perhaps even a week, and then it normalized.
But we did get I guess we did get a recession from the pandemic.
We did get a recession.
Following that.
We did get a recession.
And typically, even when the curve does invert, it doesn't stay inverted for a long time. It usually sort of corrects.
I mean, that,
It inverted in mid-2007 before the great financial crisis.
Yeah.
okay.
The Fed's website has a terrific amount of information on that if you're curious. A lot of great, rich history on that. So moving into the slide deck on slide 4, I'll tie a couple of these slides together for you at the close in terms of why we're looking at them and how it might impact our views on the market. So what we're looking at here is consumer confidence. How does the consumer feel about their employment situation? How do they feel about the economy? How do they feel about their lives in general? This is a University of Michigan survey that's been taking place now for over 40 years. So it's a fairly reliable indicator. And what you see here is that consumer confidence is now the lowest it's been in the last decade. And this is prior to the invasion. So you can imagine it's probably a bit lower today. So what's causing this collapse in consumer confidence? Well, there's a couple things. So this falling confidence relates to their views about government policies. There's deep concerns about well-established rate increases that I just talked about, and the dominant issue, of course, is just inflation. The best way to think about inflation is it's a tax. And anytime that you get a tax increase, but 7 to 10% for all of us on producer goods or consumer goods, it's going to tap down demand. It's going to make consumers very concerned. And this is just manifesting itself in this report, this data slide by the University of Michigan. This next slide just digs a little deeper at this same consumer confidence survey point, and it's asking a more specific question about how do you feel as a consumer about purchasing large household durable goods. And the definition of a durable good is something the consumer buys that is expected to last 3 years or more. Best way to think about it is a washing machine, refrigerator, dryer type home purchase. And you can see this is just also completely collapsed, consistent with the consumer confidence. And this is a result of near sticker shock prices for some of these items, very long lead times to secure the item, and in many cases they're just generally unavailable. So is it a good time to buy a large household durable item? Probably not. We can skip 6 and 7, and let's just go to page 8 for a moment. Telling the same story. And I'm focused on the consumer confidence and this slide on slide 8, because the consumer represents about 70% of GDP growth in the United States. So it's important to stay focused on how the consumer is feeling. So here, what we're really looking at is the red line, and this is trend line retail sales. So that's the essence of what this slide is about. Personal income drives retail sales. And you can see that we've had 3 spikes that track the stimulus packages that came out of Washington. So that light blue line is retail sales, and the dark blue line is personal income. So retail sales still quite strong, despite no additional stimulus packages. So that spending must be coming from somewhere, and it's coming from savings. and the consumer is flush with savings during the pandemic from not traveling, stimulus packages. Relative to history, consumer balance sheets are quite strong. So that spending continues to persist. But what we know over time by looking at charts like this is there's a powerful regression to the mean. So over time, we expect that consumer spending, retail sales will pull back towards the long-term trend line of retail sales. So what we suspect happened in the pandemic was that the retail sales just pulled forward demand, and that will start to normalize. And why is all this important? So it's important because if we look at consumer confidence, you understand where that is. It's about a 10-year low. And we see extended retail sales, which we think will start to normalize. Those two things to us tell us that perhaps that later this year, consumer demand will start to soften. It will start to show up in the economy, really right at the time when inventories are starting to normalize. Supply chain disruptions are getting better. We know they're not perfect yet, but we do look at inventory very closely, a lot of different tools to measure that. And our view is it directionally is getting better at the same time that we can see a pullback in consumer demand. That could help on the inflation side. Maybe the bull case and all that is sometime in the fourth quarter, the consumer has pulled back substantially. Inflation starting to roll over, absent. People will start to strip out energy out of inflation and look at the broader economy probably sometime later this year. And maybe the Fed says we might pause, which would be quite a positive move for equities. Those are the kind of things we're thinking about.
Fed says we might pause?
They might pause from a rate increase.
Okay.
Later this year from their tightening campaign if some of those things come to pass. We recognize that a lot of things have to go right for that to happen, but we have to focus on all of these scenarios to understand what the outcome might be later this year.
Can you remind us where the Fed got in the last rate hiking cycle? Did they get to 2%?
I think they exceeded 2%. I think it was closer to 2.5% in the last cycle.
So you're saying they're going to get back to there in a year and a half, 2 years?
Probably 250.
Yeah,
Yeah.
that would be our view.
And by the way, and then Landon, in all likelihood, cutting rates to stimulate economic demand.
Shortly after reaching the 2.5?
If not before.
Most likely.
And so, and this is, I think, one area where, we think that the market's a little bit wrong in that there seems to be this expectation that interest rates are only going higher from these levels. And we think there's sort of a natural limit on how high interest rates are going to go. They're not going to go to 4, 5, 6, 7%. And I think there's sort of this view that that's entirely possible. We think as the Fed increases interest rates, the economy is going to slow. I think some of the data's probably are, with consumer confidence and retail sales potentially rolling over, that we're going to start to see that come through in the data. And the market's not really focused on that. It's focused on what's the Fed going to do because it needs to normalize policy. But again, it can only, in our view, go up a certain amount.
Do you think after we, at some point, all the things that were happening before the pandemic, the low rates, low growth stuff is going to come back?
I would say that that's entirely likely. I think the pandemic...
Lower for longer.
I'm sorry?
Lower for longer.
I think that's right. Now, arguably, it's a little bit of sort of this teeter-totter thing because you can look at some of the data and say, well, interest rates have to be higher and they have to continue to go up. The indebtedness in this country, inflation's not under control, all those things. At some point, inflation will get under control. And I think in all likelihood, the way it gets under control, and we're not by any stretch predicting a recession anytime soon, but Jim talked about this policy mistake. In all likelihood, what's probably going to happen is the Fed's going to tighten too much. It's going to bring about the recession, which recession means that the demand side goes down. When you got less demand and supply side's fixed, well, then prices come down. That's how you get a handle on inflation. And so ultimately that'll happen. But you're right. So what was driving the interest rate environment, the inflationary environment pre-pandemic? It was an aging demographic in this country. That hasn't changed. It was low levels of economic growth without additional levels of stimulus. It's sort of the law of large numbers in some sense. It's really hard to grow an economy at the size of the U.S. at 3, 4, 5, 7%. It's unsustainable. And the reason we think inflation ultimately comes back, and I don't know if it's going to go back to sub 2%, but it's certainly not going to be 7% forever. But I think sometimes we forget the disinflationary power of technology, and the stuff that hasn't even been created yet is so powerful. And so that is very disinflationary in this country. So we will get back to that point. Is it going to happen tomorrow? No. Is it going to happen 2 years from now? Not likely. But at some point, we will get back to that environment.
I think we all remember the 1980s with a 12% mortgage and
Yeah.
gas prices
Yeah.
that went through the roof. And how do we differ today from that? Maybe you can tell what's the difference?
Yeah, it's interesting because I haven't really independently verified this, and I have some numbers I wrote down. But I saw something that was a little bit curious. And so CPI last year was about 7%. Inflation was about 7%. Now, it certainly isn't what it was in the early 80s or late 70s. That was double-digit kinds of inflationary environments. The interesting thing about it is they've made changes to the way CPI is calculated over the years. So if you back out some of those changes that were made, CPI is probably more like double what the headline number is. So, Danny, I guess maybe today isn't all that different from what it was back then. I think what you've got, though, is a central bank in this country that is certainly more willing to fight that battle. And so are we going to see headline numbers, particularly when you strip out cost of energy, that get to those kinds of levels? Probably not. And if that's the case, if you have a Fed that's going to use the tools at its disposal to get a control on that, that's why we think that we're not going to see those kinds of inflation or interest rate environments like we saw 30, 40 years ago.
What is your opinion on stagflation? We start going through a period now where growth slows, but inflation doesn't decrease.
We're pretty high probability we're going to see that happen because we already have the inflation component.
Yep.
And we see growth already slowing. If consumers driving 70%, the question is how long will that persist? So this year is definitely going to feel like stagflation to investors and to consumers, right? We're earning a rate of return on fixed income, but that fixed income return is getting eaten up by inflation. The question that matters most is how long will that persist and how long will that take the Fed to get that inflation back down to under control. But until then, as growth slows, it is a stagflation environment. And back to your other question, really it was Paul Volcker who decided he was going to break the back of inflation as the Fed chair at that time, and he was willing to raise rates, short rates, to north of 15%. So we're talking about 2.5%, 3% here. There was no comparison to what he was willing to do. So he created a Fed tightening campaign like we've never seen, and he knew what was going to happen. We went into a very deep recession after that for almost 3 years, 2.5 years. But inflation didn't come back after that. This Fed has a much more focused dual mandate, which is price stability, inflation under control, and full employment. So it's a very, I think, different construct in the Fed versus what we saw under Volcker. In terms of the long-term interest rate outlook, one of the things that we talk about internally and we all, Brian and I, wrestle with is this long-term forecast for interest rates. And the strategy team at Morgan Stanley looks at it and says, at least in the near term, until there's the next recession, this lower for longer rates will be our view. But one of the things that we're focused on is, well, what was the driver of that low inflation, low interest rate environment? And of course, central bankers around the world like to take a bow and say, well, you know, we balance growth and inflation in terms of our money supply, interest rates, et cetera. But a big driver of that is not repeatable is that there were hundreds of millions of jobs, low wage jobs coming out of Asia, China in particular, that allowed that deflationary cost to be imported into the United States and the rest of the world. And those low wage jobs, those are gone. They're not, if you look at the demographics in Europe and Asia and China and the United States, it can't repeat. So we don't think any of that will manifest until we go through the next recession, but that's something that we're looking quite closely at internally. We don't have an official view on that yet, but that's what we're focused on. Slide 9 shows the consumer and how tied to the economy and the financial markets. Here she is at the moment. The consumer's never been more leveraged to asset prices. So what we're looking at here at the blue line is consumer net worth, and then we've overlaid the S&P 500, and it's consumers are more involved in the stock market than they've been in the past, not only through their pension, profit sharing, 401ks, but the consumer has been an active trader during the pandemic. One of the reasons it's been hard to get some people to come back to work. So the Fed is aware of this.
Isn't this kind of a good thing? I mean, the alternative is they just have cash. Don't you want people to invest?
It's not neither good nor bad. It just is a sensitivity indicator that the Fed is aware of. So if the stock market goes into a bear market and we're down 30 or 40%, it's going to have a much more profound implication on the consumer than it would relative to other times in history, is the point here. Which is, to your point, why the consumer balance sheet looks so good and participated in this rally. But the last slide I will review with you is the S&P 500 earnings and price targets. And really, we're looking back over time, going back to 2014. And what this blue line shows us really is just a price change of the S&P. And that tannish line is the earnings revision breadth. So it's ultimately the stock market goes up because earnings are getting revised higher, or investors are anticipating, because they're always looking forward, never looking behind about what those earnings will be going forward. And we're coming off of 4 quarters of 20% EPS growth for the S&P 500 earnings. Really, really hard to beat that. And so now what we're seeing is a deceleration in those earnings. In fact, for the first quarter, about 75% of the forward-looking guidance was negative. So again, just another hurdle for investors to get over. It's after 4 quarters of 20% EPS growth, now that guidance is starting to roll over. Also have to deal with rising interest rates and concerns about where inflation ends up. So that cocktail is a tough hurdle for investors to get over, and it's why we started the year saying it's going to be really difficult here to make money. And our starting point of where we expected the indices to be in the United States were lower than where we started the year, and that hasn't happened in a long time. So last time I was here, I talked about a 10 to 20% correction. Wouldn't be out of the realm. It hadn't started at the time, and now we're about call it down 12, depending on the day, 10 to 12. And we still think that that 10 to 20% range is possible. And we probably are leaning towards the more negative end of that, just because of the last time we spoke, we didn't have a war in the Ukraine with Russia and the unpredictability that's causing global investors. So when you have that concern about a contagion effect, something militarily happening other than what's happening in Ukraine and Russia, you've got to factor that into your price targets. And also now the additional inflation that we're going to see because Russia's going to be locked out of the global economy. So this all has portfolio implications, and I think this is a great time to turn it over to Brian to express how we think about implementing and making changes to the portfolio and some of the things that we've done in the past.
After that rosy outlook. And by the way, I just noticed this. I can assure you, this is not company sponsored.
It says Morgan Stanley right here.
How about Morgan started uniforms or something?
Yeah, right, exactly. Wow. Okay, so maybe just turn to slide 15 quickly, because I want to just review kind of the portfolio positioning at the end of the year, because it's going to, based on some of the things Jim said, it's going to kind of inform some of the changes that we've made in the portfolio subsequent to the so far this year, and some of the changes we're likely to make going forward. So in terms of our overall stock bond mix, our target is 70% to stocks. Right at the end of the year, we were pretty much right on target, slightly overweight, 70.8%. In terms of bonds, our target is 22%. We were at 22.5%, so again, right on target. And then alternatives, we've got a little bit of, we've got some real estate, we've got some hedge funds. Investment policy statement allows up to 10%. Right now, we have a target of 8%. We were slightly below that, about 6.5% or so. Really hard to manage the allocation to alternatives because they're not as liquid as the rest of the portfolio. But that's where we stood at the end of the year, effectively right on our target allocations in terms of our broad stock bond mix. Where we were different, in particular, was within the equity space. So we were underweight large cap stocks in the U.S., and we were underweight large cap stocks in the U.S. primarily because of a value from a valuation perspective. Those kinds of stocks, although they did the best in 2021, were the most expensive when you looked across the globe. And so we were underweight, in all honesty, the best returning sector of the equity markets. We were overweight somewhat, small cap stocks in the US, but a bigger overweight for us was in emerging markets. And again, keep in mind that this was before Russia invaded Ukraine. And so that relative positioning had some implications for us in terms of the overall performance in 2021. Now, what have we done since then? In January, we've reduced, and this is before the end of January, we reduced our emerging market overweight. We're still overweight, but we reduced it because we saw markets decline in January, and we wanted to take advantage of what we thought at that point in time were somewhat depressed values on the U.S. equity side, and as what typically happens when markets correct is that oftentimes the U.S. stock market leads the globe in terms of the recovery, and so we reduced our emerging market overweight. We bought U.S. stocks on that belief. We also swapped out of one of our emerging market managers. So those are the actions that we took in January. We took further action in February, where we reduced even more, not our exposure to emerging markets, but our exposure to one of the active managers that we have in emerging markets, and we put an index fund in place in that space. just to get a little bit more defensive, to get a little bit more conservative, given everything that was going on. We didn't want to undo what we think is going to be a long-term positive for the portfolio, being exposed to emerging markets. But we did want to get a little bit more defensive in that space, and that's what we did. I'll come back and talk about results through February and exposure to Russia and all that, but I just wanted to kind of let you know where we were.
When did you drop it back from 11.8 to what, the ballpark? Do you have a number?
So we are, we're 3 percentage points, at the end of the year, we're 3 percentage points overweight to emerging markets. That's dialed back. We cut that in roughly half. So we're about a percentage, 1.5% overweight to emerging markets. If you could flip back to slide 13. Here's where the rubber meets the road in terms of our performance. So let's talk about the good stuff first. On the column, the second to the left, on page 13, the year-to-date return, so calendar year 2021. We started the year at about $240.3 million in assets. Benefit payments, net of contributions, were about $18 million. Investment earnings, $27.5 million. We ended the year at right around $250 million in total assets. So assets went up, which was great. You calculate the percentage return, that $27.5, $28 million in terms of dollars, convert that into a percentage. We were up about 11.75% in 2021. So good in absolute terms, certainly better than the 7.25 actuarial return assumption. But when you compare it to a benchmark, we were behind. The benchmark's return was 13.5%. So we underperformed, what is that, by 175 basis points. Now, what was driving that? Talked a little bit about underweight to large cap U.S. stocks, that being the best returning part of the capital markets. The S&P, again, to remind you, was up 28% or so last year. We were overweight emerging markets. So that hurt us. But what hurt us more, in all honesty, is our exposure, the active managers we had in the portfolio. Pretty much all of them underperformed in 2021. Now, why is that the case? So if you look through to the things that worked in 2021, they were very different than the things that worked prior to 2021. So the things that worked in 2021 were value-oriented stocks, stocks of energy companies, stocks of financial companies, stocks of companies that have high levels of debt on their balance sheet. Other things that worked were companies that paid dividends in 2021. The things that didn't work are companies that are growing their earnings and their revenues more quickly than the market. Quality companies, what does that really mean? It's companies that don't have a lot of debt on their balance sheet. It's companies that have very strong brands in the market in which they serve. Those features, companies that have low levels of debt, have strong products in the market, and that are growing their earnings and revenue, those are really good things to hold for the long term. But there can be discrete periods of time, like a calendar year, quite frankly, like multiple years, where those strategies don't work. And I would say if there was any single factor that caused the underperformance in 2021, it's that. Now, we had managers that picked bad stocks too, and I'm not diminishing that. But the kinds of managers that we have and that we like over a long period of time happen to be those kinds of things that didn't work in 2021 and haven't worked in the early part of 2022. So that's that more than anything is what's driving the underperformance. You look over the last 3 years and
Brian,
yeah.
when you're looking at the managers who manage these portfolios,
Yeah.
are you looking again at the long term, or are you looking at a short term when you decide to make a change?
Absolutely over the long term. And part of the reason why anytime you hire active managers, there's not a single active manager in the universe that outperforms every single year.
Right.
Styles go in and out of favor, any number of things can happen. What we do prior to investing with any manager is we get really comfortable with what their approach is and how they navigate different market environments. So we know what their biases are in building the portfolio going in. So when we get to periods where the kinds of stocks that they own are not doing well, it gives us comfort and it doesn't surprise us. And so over a long period of time, we have every expectation that every single active manager in the portfolio is going to outperform the benchmark. Doesn't mean it's going to happen every year. I wish, and this didn't happen this year, last year, I wish there were some managers that protected or outperformed, and we consciously put managers and portfolios together that are complementary, so we're not redundant in having multiple managers that are doing very similar things to one another.
Right.
It just so happened that this philosophy of using managers that invest in good companies, that are growing earnings, that don't have a lot of debt, hasn't worked. It has over a longer period of time. Yes, sir.
What is the percentage of active versus passive investments in our portfolio? And is there a desire to increase the passive investment?
Yeah. So we did increase the passive investment so far this year. We've added a passive investment in emerging markets, and we are in the process of adding a passive investment in developed non-U.S. markets. That does not mean that we want to go fully passive. But with all the volatility and all the uncertainty going on in the market, we think it's prudent to become a bit more defensive. And part of that defensive posturing is to move closer to the index, the various markets in which we have exposure. And that's what we've done so far in 2022. That's what we're likely to continue to do in the coming months. Now, there will be a point, as Jim talked about the outlook, we think there's still some volatility and choppiness that's likely here in the near term. Yesterday was a huge day. And by the way, global equity markets, not just here in the US, but across the globe, down 10% this year. I'll tell you, it feels a lot worse than down 10%. And I think the reason for that is because you've got certain days and weeks where you have consecutive days of 1 or 2% down markets. And then you have a massive reversal like we had yesterday. Yesterday, technology stocks were up 3.5%. The S&P was up 2%. And so the volatility is more extreme than what a negative 10% is a pretty normal year. It happens all the time. Pretty much happens every calendar year. But with everything going on, with the consumer rolling over in this country, with more uncertainty on the inflation side, with nobody really knows how this whole Russia-Ukraine thing is going to play out, we want to move closer to the benchmark, and that's what we're doing.
How much percentage did you move? Looks
So
like you were like 80-20.
We're 80-20. We're probably about 25% right now in passive across the board, across all asset classes. That will continue to tick higher.
Is that enough that it's moving the needle on fees?
So we've got pretty low fees on the active management side. But yeah, I mean, the index fund fees are, call it, 4 or 5 basis points. Even at low active management fees of 30 to 40 basis points on some of these things, it will have an impact. Would have a huge one? No. Because we don't want to throw out the active managers, because we do think strongly of them over a long period of time. And in all likelihood, if the world plays out in the way we think it's going to do, and let's say we pull back another, 5 or 10%, the issues the geopolitical issues get resolved and things start to settle down, what you're likely to see from us is we're going to lean back into some of those managers, some of those active managers. So I would view this, and I don't want this to sound like a trader's mentality, but we have a view, and that view is causing us to be a bit more cautious, and so we want to, become a bit more cautious. But we don't want to have that positioning for the long run, because these managers, all of them across the board over a long period of time, have generated significant levels of excess return. Okay. So, but Mr. Hawley, just a quick comment on page 13, the long-term track record, again, recognizing this is through 12/31 of last year. If you just look at the last 3 years, and that's roughly in line with the time period of our discretionary mandate. So this board, there's some new members here. You'll recall we've worked with the board for a while, but the mandate changed in the fall of 2018 to where in the past we would make recommendations to this board and the board would approve or disapprove of it. In 2018, the fall of 2018, we started to have discretion. So we would make the changes that we thought were appropriate to make, and then we'd come back to you and report to you and tell you what we've done. And so since that period of time, the return that we've generated, 17.16% net of all fees, benchmark's return of 16.4. So even though we've underperformed in 2021, there was still that margin of excess return relative to the benchmark. Now, if you turn to this slide, this handout, this is the results through February. And keep in mind, this is just the marketable securities part of the portfolio, because we do have about 8%, about 7 or 8% of our portfolio in alternative investments whose value does not get updated regularly. So we're stripping that out. So we're just looking at the 92% of the portfolio that's invested in public markets. You'll see that these managers underperformed the first 2 months of the year. We're down about 8.5% in that piece. The benchmark's down about 6.5%. But when we think, and we'll see when the first quarter results get published, that alternative investment exposure that we have probably done a little bit better than the overall public markets portfolio. So we would expect we're probably still slightly ahead of the benchmark once we take that into account since the time we had discretion. But you can see some of these managers are down fairly significantly. We can talk about any number of these, but it's still those things that weren't working in 2021, those value-oriented companies, those companies that are paying dividends. Not that we don't have exposure there. We do. Don't have enough of it. And those companies that are growing their earnings, that have low levels of debt on the balance sheet, continue to struggle. And those are the companies we have more exposure to. I know there was a question about our exposure to Russia. So we do have some exposure to Russia. We have about less than 1/4%. And it's concentrated really in one holding. We have exposure to Lukoil, which is a Russian energy company. We have about 12 basis points of exposure there through one portfolio.
It became a very hot topic with the retirees. Of course, I guess you're welcome to chuckle that I'm close to there, or if not, should be. So my phone has been jumping.
Yeah.
For the moral issue, not so much financial, but are we investing in Russia?
So we have small exposure through not only one active manager in particular, but because we have now an index exposure to emerging markets, that index has some exposure too. When you look across the entire portfolio, we have less than 1/4%. And I would say one of the changes we made in January, at the end of January, was to replace a prior active manager, which was called Lazard. We added a firm called Martin Currie.
Lazard had another 15 basis points or so exposure to Russia. So that change, we didn't know this was going to happen. We just replaced them because we thought this new manager is going to be a better fit for us over the long run. But that change saved us another 15 basis points of exposure. So we're not consciously investing in Russia, but one of the active managers we have in particular did have some exposure. But it's been pretty
Is it fair to
limited.
say that we've really cut the exposure in half, and it's still, but it's
Cut
doing well
itself
right
in
now?
half.
And then, yeah.
And then some.
Right.
Just trying to help him when he's talking to folks.
Well, it is, and
Correct
I didn't
narrative.
know that my phone would jump in relation to headlines, but it did, it started.
Would you mind giving a brief description of what Luke Oil is?
Sure. So
It's a a significant energy company, and I would suspect that your manager is holding that.
they can't sell it.
Oh, yes.
Yeah. So we have exposure there, and we in all sort of reality, we can't get out because trading has been halted in any Russian.
Well, I guess my reply has been too that your life should be weighted with morals, but there again, you don't give away your bank account and go hungry because you don't like the world's pulse at the moment. And so there has to be some, this is what I want to do, but I'm not going to devastate something else because of it.
Yeah, and I would think that the narrative too is, in some sense, because of the way we invest globally, it's almost impossible to avoid. The good news is that our exposure is very, very limited. You're right. I mean, the exposure got cut in half, well, because those stocks have declined significantly even before, the trading restrictions were put on place. But because of that move we made at the end of January before Russia invaded, we cut it in half again.
It's still okay, I think, to take credit for by making some other changes.
Yeah.
We are fortunate
Yeah.
to not be heavily into this and have to make heavy changes. So
Yeah.
that, if everybody, I'm looking for an opinion, that would be my reply.
I think that keep it as clear and simple as possible. That's a good way.
That's me, yeah.
Brian, didn't you say you were going to reduce your holdings in emerging markets too? So is that one of the funds that we're going to look to move further out of in the future anyway?
So ironically, the active manager that has exposure to Luke Oil, and that's our biggest holding, and is one of our developed non-U.S. equity managers. So they have a little bit of their exposure in emerging markets. Very, very small amount is coming through from the actual emerging market exposure. But so one of the things we're going to do, and one of the things we've done, is we've added an index fund in developed non-U.S. equities. So we're going to reduce, again, to get closer to the benchmark, get a little bit more conservative. We're going to reduce some of that exposure to that active manager. So by default, we're going to reduce our exposure.
Would you say 12 basis points?
12 basis points is the exposure there. It's pretty de minimis. So half of it is coming from that, and half of it is coming from our actual emerging market managers. So I'm sorry, I know Landon, you asked so Luke Oil is a company based in Russia that is, you think about it as an oil company. They're extracting oil and gas from Russia and sending it to the various parts of Europe and the rest of the world. Not all that different from a sort of a exploration company here in the U.S., but that's what they do. And the reason why managers own that stock, again, prior to the invasion, is because Russia is one of the, if not the top exporters of oil in the world. And so oil is a global commodity, whether it's produced in Canada, U.S., Saudi Arabia, or Russia. It's the same product, effectively. And so
those companies had been attractive investments because the price of oil was going up. The price of oil last year went up 61%. So I would submit, this investment was a pretty good one.
Good investment to make.
Now the price of oil has obviously gone up. The Russian energy companies aren't benefiting for obvious reasons.
So I think if I'm doing the math in my head right, 0.25%, it's less than $500,000 of exposure of our 250 million.
Right.
I think that one holding in that one account was like, our cost basis on that's like 270,000. It's down to, tens of thousands of dollars now, but that was our exposure.
And there are some emerging market managers that have had 25, 30% exposure just because they liked it a great deal and they viewed it as quite stable. World demand for oil, quite stable long term. So when we look at our relative exposure, it's not zero. So it's not anything above zero is impactful, but it's relatively insignificant looking at the total. And most of the fund managers, even though the companies may trade at some point in the future, they're untradeable now. So at the fund level, they've written them down to zero.
Yep. The other thing I'll say on this side, again, David, on the longer term results. So since inception, I show the since inception results here of all the active managers. Most of them, and long term here is from 2018. And I appreciate that's not really a long term period, but that's the period from when some of these managers were put in place. Poland's a large cap growth manager, underperforming, right? But they're up over 20%. Their benchmark's up 23. They're, within a stone's throw away. Aristotle, which is our active large cap value manager in the U.S. They're underperforming in the current environment. Their longer term returns beating the benchmark. Rice Hall James is one we've talked about. They've actually held up relatively well, and so they've got some ground to make up here. Delaware is a small cap value manager, outperforming over the long run. Our two active developed non-U.S. equity managers are both underperforming, and this is a short period of time. Again, you look over a substantially longer period of time, say 5 years, 10 years, they're both significantly outperforming. We're not concerned about them. And by the way, it's the Hartigan Loeffner portfolio that had the Lukoil exposure. Matthews, which focuses on companies in Japan, underperforming over recent periods, still outperforming over the since inception period. And Artisan, which is this is the manager that's struggled the most. This is one of our emerging markets managers. We've had them for a long time. Last year in 2021, they were down about a little bit over 9%. The benchmark was down 2.5. In 2020, Artisan was up 80-something%. And you look over the long term again since 2018, they're still up 23%. Their benchmark's down 3. In all likelihood, as Jim talked about, we think there's further downside to the equity markets. Maybe it's 5, maybe it's 10%, maybe it overshoots even. In light of that, we want to get more conservative. We've been reducing exposure to Artisan. Okay? We've been reducing exposure to our active managers in the U.S. large cap space. We're going closer to the index, again, getting more conservative. I would say if and when we get to that point where markets are down maybe 15, maybe 20%, we are much more likely to lean back into these managers because we like them. I know that is not what you typically hear from institutional consultants, but that is how we would expect this to play out. So I know we've taken a lot of time. I think it was important to review things. We're happy to talk about anything else on your mind.
All right, sounds like no more questions.
I'm looking at a, 11% annual rate of return after fees.
That's right. So
I can live with that.
it's improving the funded status at that level, and that's what we're ultimately, we're all focused on.
And that's 11 since you became discretionary, correct?
Correct.
Yep.
So that's just the public markets piece.
Yeah.
So through the end of last year, it was closer to 17.
Okay.
Thank you.
Okay.
Thank you.
Brian, you, I didn't remember you going over this, but, we kind of looked at the funded status. It's dropped a
Yeah,
little bit.
It has, yeah,
77.4% you're estimating
at the end of February.
in February, and it was,
It was 84 something.
it was very high, yeah.
Yeah.
So just
Yeah, it's,
good to know for the retirees, we still have a very good funded status.
Yeah,
correct,
very much,
correct,
a lot better than in years past.
correct.
Could be better, could be worse, yeah.
Yeah,
But the city is putting in a lot of money.
indeed. And the investment returns and absolute returns are far exceeding the actuarial assumption.
And the city is, out of the general fund, is paying the debt service on the debt issued that produced these
Yeah.
funds to be invested.
Yep.
So not only making a contribution to the fund, but also the debt service. So it's well over 20 million a year.
And Patty, is the city committed to put X number of dollars in per year? Doesn't matter what return is being generated? Or do they look at, well, they made X number of dollars in return, so we can cut back our contribution this year?
Right now, the actuarial study is done, every fall, and
Right.
that is used to determine the amount the city will budget to pay into the fund.
Okay.
Yeah, so it's the makeup, the census of the retirees and the actives are all taken into account and projected, and that's what they've been doing.
Okay.
So the actual investment return at the margin will reduce the required contribution of the
Correct.
city, but because of the actuarial techniques, it's smoothed over a 5-year period. So one good year's worth of returns only really accounts to 20% of that calculation.
And conversely, bad returns
Yep.
are smoothed out as well.
Exactly. Yep.
So just so the city is committed to funding this, so they know that it's important, and
Good. Thank you.
because it also funds its Virginia retirement system based on the rates that VRS sets. It's a huge commitment to post-employment benefits at many levels, and it's at least 20 pages of notes in the annual report, what all those liabilities are. If you really, need help sleeping, read that.
Okay.
So I think these last two agenda items, the reconciliation of market value and the John Hancock report, was shared via email. I don't think we're going to cover them.
And that's the funded status of the 77.4%. That's that reconciliation. The material for December 31st is sort of like old news when the market was up, and this most recent estimate, I think, helps give a clearer picture of where we are.
Yep.
And also, Mr. Tom Shanley was not able to be here, but he did supply some information if you wanted to go over that. But it was, the star of the today was really, what's the market doing?
And so we're changing so quickly, you're going to have to come back tomorrow and give us a
Well, it's going to snow in Chicago. I'm happy to
Switch
stay
to
here.
weekly reports.
Well,
You brought up a good point with the geopolitical situation the way it is. Should we consider even by a Zoom meeting more than quarterly at this point in time, or are you comfortable with quarterly meetings?
Holding more meetings because of the volatility.
Yes.
And what's going on in the market.
Or do you even think that's necessary?
It's,
I would say no, but I'm open to it if everyone else thinks we should have more frequent meetings.
I'm not suggesting we have, the fewer meetings, the better as far as I'm concerned. What I'm thinking is I think Russia planned on taking Ukraine in a 3 or 4 day period, and it's not going to happen. And if it continues going in the trend that it is now, it may have, particularly since the world has shut them down, that trickle-down effect may have a big effect on the market and what it is. Now, what I'm saying is we don't need to get together in person, but even the investment committee maybe should touch base on a monthly basis with Brian or
Yeah,
somebody.
we're happy to do
I
that.
mean, if we could certainly, schedule a 30-minute call once a month with the investment committee to touch base.
Yeah.
Yeah,
great.
or if the market activity triggers us to make portfolio changes, that could be the catalyst for a discussion.
Yeah,
Actually.
yeah. We'll just play it by ear.
Yeah, whatever works best for y'all.
Maybe just an email, so there's some comfort.
Yep.
Yeah.
When the phones are jumping
Yeah.
and the headlines are jumping, that we say that we're staying really close
We're
on top of it.
Should we leave it at, from time to time, you guys, if you're making changes or views change,
Just the email.
paragraph on.
Sure.
That would work too with me.
Or if, let's just say this expanded into a NATO backcountry, I mean, that's a completely different issue. I think it probably warrants.
Well, we're not going to be around here to worry about that anyway.
Right.
Not in this market.
Yeah, right. That would warrant, I think, probably
You guys in the Midwest might still be there, but we're going to be gone.
I just want to ask, how many people are on the investment committee?
So it's you and me and,
Do we have a public meeting
so-
issue?
I thought it was Mark,
Mark was.
but
yeah.
I thought he fell off the board.
He did, yeah.
So we do have a opening on the investment committee. We can address that later.
That is up to you, but I was just asking Mr. Challenger whether, do we have to have a public notice if there's 3 or more?
For the investment committees, historically, we have not,
Okay,
just for the retirement board meetings. So for the purpose of what we were discussing before, it makes sense to do it as an investment committee meeting, so it doesn't require us, because we can't do Zoom meetings for the regular
Okay.
retirement
All right.
board. But for the investment committee meeting, it can be.
Oh, you can? Okay.
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 So we can look at doing that.
If you think it's necessary, I'm okay with letting you make the call, depending on how much changing y'all will be doing.
Okay, fair, perfect.
If you're
And then there's
comfortable
nothing
with
wrong
that,
with
Landon.
the investment committee emailing us to keep us up to date.
Right.
That would be a good comfort level too. Not that we don't trust them, I mean,
Well, it's just
being
information.
in the know,
Yeah.
Staying informed, absolutely.
yeah.
Okay. Will do. If I think that's everything.
Because they do have Wi-Fi in St. Thomas. That's generally where we meet.
Where is that in the
That's
budget
really
line?
I was just going to say that.
I guess I shouldn't kid about that.
I was
We're
going to leave
being
our regular
recorded.
quarterly meeting May, so that's just 2 months from now. Unless this body would like to make it 3 months, but we would then be back on our regular quarterly schedule.
I think we should get back on the regular schedule.
Yeah, so that would be May,
Okay.
and we probably need to talk about the annual meeting of this group that we haven't had, that you asked about earlier, and I will research that, and then also whether we need to do a city council brief. And that,
Now, is meeting with the council, that's not our annual meeting? They're two separate meetings.
not
Okay.
according to the bylaws, yeah. So we'll see if we can perhaps make May that,
Sounds good to me.
depending on what other business we'll have at that time.
And that's the second Thursday in May, right?
Yes,
May 12th.
yes, that's the date on my calendar.
Is that it?
Meeting adjourned.
Meeting adjourned.
Thank you.